Hi, I'm Larry Perlman, a tax analyst with Wolters Kluwer CCH, talking to you about reasonable compensation and nonprofit organizations. There are restrictions on the amount of compensation a nonprofit organization can pay its employees. Both the amount and procedures used to determine compensation are important. Violations can trigger a large additional tax for the employee who receives the compensation and the organization managers who approve the conduct. In extreme cases, an organization's compensation practices may result in the revocation of its federal tax exemption. However, a tax-exempt organization may pay reasonable compensation to individuals who provide services to it. So what is reasonable? Whether compensation is reasonable is determined by looking at all the facts and circumstances. Reasonable compensation is the amount ordinarily paid for like services by like enterprises and under like circumstances. This is known as the like rule. In determining whether compensation is reasonable, the parties to a transaction are entitled to rely on a rebuttable presumption of reasonableness for a compensation package if 1. The compensation arrangement or the terms of the property transfer are approved in advance by an authorized body of the tax-exempt organization composed entirely of individuals who do not have a conflict of interest with the compensation arrangement or property transfer. 2. The authorized body obtained and relied on appropriate comparability data. And 3. The authorized body adequately documented the basis for its determination. An authorized body means the governing body, that is, the board of directors or trustees, a committee of the governing body, or, if allowed under state law, other parties authorized by the governing body. Nonprofit employers may look to both nonprofit and for-profit sectors for comparability surveys and data. However, an IRS official has cautioned that using nonprofit comparables in determining an appropriate level of executive compensation will be viewed more favorably by the IRS and is less likely to result in an examination. No specific number of comparables is required to justify compensation. However, in the past, the IRS has stated that meeting the rebuttable presumption of reasonableness requires 3 comparables. In approving compensation, consider all items of compensation, including items such as cell phones and cars. Approval should be recorded in either the board or committee minutes. Best practices dictate using an independent compensation consultant. The more independent the specialist is, the more weight the IRS will give the study because this shows due diligence of the board. To avoid insufficient oversight by the board, the full board of directors should annually take responsibility for the chief executive officer's compensation and periodically review the entire staff's compensation program. The board may also want to adopt a written compensation philosophy or establish a dedicated compensation committee. Another best practice is for officers, if attending a meeting, to recuse themselves from the debate or voting regarding their compensation at the meeting. The IRS may assume that these individuals were present at the meeting unless the minutes reflect otherwise. An organization should approve each individual compensation package in a separate vote. Finally, justification for paying increased compensation may include an individual's fundraising ability or unique industry knowledge or skill set. Also consider the ratio of revenues to proposed compensation, the ratio of expenses to proposed compensation, the executive's track record, written offers from unrelated enterprises, and competitive market pressures. For more information on reasonable compensation and nonprofit organizations, see the Wolters Kluwer Nonprofit Tax Library on IntelliConnect.